Traders are watching these levels to place buy or sell orders. This is what we call swing low to the highest point the market got to before the price start reversing. I repeat, from the swing low to the highest point the market got to before reversing back down. That reversing is what we now called retrace. It's before the market start retracing. Again, from the swing low to the highest point the market got to before it start retracing back down. So that retracement is what you want to cash. Don't forget, remember when we said when the market return pathway and then buy again. So this one is going to find support at the 38%. So the 38% is a support. The 50% is a support. The 61.8, if you remember what they say about 61.8, the golden ratio, right?
Yeah. Yes.
Is a support. The 78 is a support. The 100% is also a support.
Okay.
So all these are support and resistance are support levels. If the market is coming down, it's acting as a support. Let's assume the market is not going. Let's assume the market is going up, or it's coming down in a downtrend. So this is a downtrend. In a downtrend, price drops down, right, and then pull up.
Yes.
As you start pulling up, get your Fibonacci retracement. Drag it from this top right here all the way down. Now you are going to take the retracement when it's coming down. This is it. So this one is in a downtrend. This one is in an uptrend.
Yes. Yes, sir.
So what are you doing here now? What are you saying? You are saying what? You are saying that once the price pull back into this 38%, you want to buy. You want to look for buy.
Yes.
Because that 38% can be what? It's a what? It's a support. If it comes to 50%, you want to buy. Because 50% is a what? It's a support. If it comes to 61, you want to buy. So if you get to 38 and it could not buy from 38, it can drop to 50. If it does not buy from 50, it can drop to 61. If it does not buy from 61, it can come to 78. If it does not buy from 78, it can come to where? 100.
100.
If it does not buy from 100 and it breaks, that means it's not going to buy at all. It's going to continue selling.
Okay.
So within these 38, 50, 61, 78, the market can reverse
100.
From those levels.
Okay.
Market price can reverse from those levels. So let's read the book and continue. The first thing you should know about Fibonacci 2 is that it works when the market is what? Trending. When it's going up or coming down, not in a sideways market. Not when the market is in sideways. Okay. The idea is to go long, which is to buy. The idea is to buy on a retracement at the Fibonacci support level when the market is trending up, and to go short or sell on a retracement at the Fibonacci resistance level when the market is trending down. Fibonacci retracement levels are considered a predictive technical indicator since they attempt to identify where price may be in the future. Since they attempt to identify where price may be where in the future.
Yes.
The theory is that after price begins its new trend, like this now, to the upside, what happens next? The price will retrace or return pathway back to the previous price level it was going before the pattern appeared. Now, resuming, and then before resuming in the direction it was of the trend. So the market will reverse back before it will now resume and start going up again. Are you getting this?
Yes, sir.
Okay. Finding Fibonacci retracement levels. You know, in order to find Fibonacci retracement levels, you have to find the significant swing high. Take note, the word significant is very important. The significant swing highs and lows. Then for downtrend, click on the swing high and drag the cursor to the most recent swing low. For uptrend, do the opposite. Click the swing high, the swing low, and drag the cursor to the most recent swing high. You got that?
Yes,
okay.
Sir. Yes.
So that was what we did just now. When we said for an uptrend, drag from the swing low to the swing high, and you get your Fibonacci levels. For a downtrend, do what? Grab the swing high to the swing low, and you get a retracement level. Do you get that, sir?
Yes, sir.
Okay. If the price get to 38% Fibonacci retracement, the market can buy from 38. If it does not, it can buy from 50, right? Like I said.
Yes, sir.
The price may to buy from the 38% Fibonacci retracement level. Ask me why. Why do you think so? Because, are you hearing me?
Yes, sir.
Because there are literally less people who are interested in that zone to buy from that area. So if there are people that are not interested in 38 because it's the first level of the Fibonacci retracement, and the market has not also go down, it has not gone at least half of this previous buy that started from here.
Yes.
People will say, okay, 38% will not hold. Let me not buy from there. Let me wait. I want to wait. They'll wait. When they are waiting, when many persons are not buying from there, the market will do what?
Go down.
Go down, thank you. To 50. Once the market gets to 50, 50 is not an interesting level. If you look at the book, they said something about 50. The market,
yes.
Okay, now look at what they say about 50%. Let's go up, and I guess you're going to see that now. The 50% ratio is not officially a Fibonacci ratio, but it was able to sneak into the group and has never left. So the 50% is not a strong zone. It's not an official Fibonacci ratio. So many people don't trust 50%. So if so many people don't use 50%, that means it's going to come where?
61.
61, thank you. You are following. That's good. 61%. When you get to 61%, what did they say about 61%? What was the thing you remember when we said 61.8? 61.8. What did they say in the book again? Do you remember? You remember when they said golden ratio?
It's a golden ratio, yes.
Okay. So the 61.8% is a golden ratio because it attracts a lot of traders and it's a significant number. So people love trading from the 61.8. So when people hear that, 61.8, that's where the market is right now, I think it's also more than half the body of this movement right here. People will say, okay. Let me enter that trade. Let me go into that trade. Let me take a buy from there. If more people buy from 61, the market will start buying from 61. If people who buy from 61 are less, the market could still come to 78. Now, there will be people who will be saying that if I buy from 61, where will I put my stop loss? If I put the stop loss at under 78, the market can go there. What about if the market now goes there and stop me before moving? Because there's still 78 after 61. So people will now say, let me wait. I don't want to enter 61 yet. Let me just wait. I prefer 78. So that let me be safe, so that I can have my stop loss under the general Fibonacci level of 100%. At least that one I'm almost guaranteed that it's not going to get there before going up. So because of people who are waiting for 78, 61 may not receive buying power. 61 may not hold. So while the market is now trekking down to 78, pushing down to 78, people who bought at 61 are rebuying again.
More power.
More power. Thank you for that word. People who bought at 61 are rebuying again. They are re-entering position again. While you that are waiting, while it's waiting for 78, once you enter at the 78, the market start turning back. It's not because of you that is buying from 78, it's because people have been stacking buys from the 61 down to the 78.
78.
So that is why most times the 78 gets a rejection. The 61 also gets rejection, but sometimes it may still fall down to the 78. It may reject from 61 first, but later on fall down to 78. Once you buy from 78, you are almost guaranteed that the market is going to buy up for you. You have a relaxed mind. You have a cool. It's like they pour water on your body. You are relaxed. Do you know why? Do you know why you are relaxed? You are relaxed because if the market does not buy from 78, and then the market goes below 100% and stop you out, because your stop loss will be below the 100%, right? And then the market stop you out from their level. That means the market is no longer going to buy. Most likely, the market has not changed trend. It has not changed trend from uptrend to what? To downtrend. We now have more sellers than the buyers. And for that to happen, it's not a child's play. It doesn't do that easily. It's not easy for market to turn direction every time. Sometimes the market starts a trend. The market goes on a trending movement. Sometimes the market goes on a trending movement. Uptrend or downtrend. Are you with me, sir?
Yes, sir.
So when you buy from 78, you have a rest mind that, okay, this is the last Fibonacci level. This is the point whereby I can say, yeah, surely, this is one, surely, goodness and mercy. Let me stay here now. Let me now put my stop loss under the 100%. Anything that wants to happen, let it happen. That is the last point of the Fibonacci retracement level. So many people have lost their trade, or so many people are losing their trade when they buy from 61%. Because sometimes from 61%, the market will give you a mirage movement. You know a mirage, right? A fake movement. Yes. Something that is never there. It will act as if it's going to buy from here and start pushing up. So many people enter buys, including me sometimes. So many people enter buys from the 61, and then the market acts as if it's going to go. And then people start stacking buys like it's going up. The next thing you see, market drops down to 78 again. So which means those that bought from 61 would have moved their stop loss back under that 61%. So when the market dropped to 78, it stopped them out. And then now you have a better chance to enter again, but because you have been stopped out before, you are not scared of entering the buy again. And maybe this time, this is when the market will now start buying up. So that's why some persons have policies and law, and their laws are like, I'm not going to enter the trade if it doesn't get to 78. There are some people like that. If he wants to move from 61, he should what? He should go. Move. Oh. If he doesn't come for my 78, if he doesn't come to my 78, if he doesn't come for my 78, I'm never going to enter the trade. I'm not going to enter that trade. Some people have policy, very strict discipline.
That makes sense. In order not to lose money.
I'm telling you. Even when I'm telling them, oh, you can enter 61%, the person will say no. Even if my mentor tell me to enter 61, no, I'm not going to enter. I don't do that. People have strict rules and strict laws. If you are a trader, you don't have a strict rules that you abide on, that you abide with as a trader. Something that nobody can change your mind. Even if they put gun on your head, you will tell the person, pull the trigger, don't worry. I'm not going to buy from there. That is the discipline that most traders don't have. People bend their law a lot. Sometimes I do bend mine and I regret it sometimes. It's because of greed. It's because I want to enter on time.
Yes, sir.
Whenever I bend it and it affects me, I'll say, oh my God, what did I do? What's even wrong with myself? I will not blame the market. I'll blame myself.
Because you know.
Because I know that point that I entered from, there is a chance that the market will not stop, will not buy from there. It may go to 78. But I'm believing that since the market is not rejecting from there, make the market not go leave me. Make I just enter.
That'll be like.
You dey see am now, Abi? Make the market not leave me. Let me just jump into the trade. Let me just enter. Make it not leave me.
You collect something.
Make I see collect. What about if I dey wait for 78? He not go 78. He can't move from 61. I'll come miss all
wait for the next round though.
And the fact is that you have been waiting. Fibonacci retracement is not a shite split to use. Because you have to wait. You have to wait for the price to create a swing high and a swing low and a swing high and then start dropping down again. Sometimes you have to be able to wait like 2-3 hours or 4 hours, depending on the time frame you are looking at it, for it to set up, for you to now buy. So after waiting for like hours, and then the market now get to 61 and they want to start reversing, you go say, I no go agree. I know the way they come since 61 I won't come buy from. Why not come 78 now?
No be lie. True.
Why is it not in 78? Why not come 78? Why I won't buy from 61? And now it start going up from 61. You go say, oh God, all die and I die. Make I enter them.
He can't go come back to your 78.
He go come back to, most likely he may come back to 78. And then he stop you out. And then you are not angry. You are not angry. The worst part is even sometimes you can even lose twice. Which means when you enter from 61, the market buys up a little bit and drops to 78 and stop you out. You can rebuy from 78 again and the market goes up again and drops down to 100 and stop you out. Because Fibonacci retracement is not a miracle worker. It's not a magician. It does not mean that the market must reverse from the Fibonacci retracement level.
Off my phone, dog.
Okay, you off your phone. So if you had bought from the 78, you would have reduced your loss to only just once, right? Only one time.
Yes, because of my stop loss of that 100%.
At B, thank you. But now that you buy from 61, you have lost twice. Now that entire day, I don't know if your mind will be settled for you to trade well that day again. You'll be angry with yourself.
Why the person is not losing real money?
Yeah, you'll be angry with yourself. Why did I enter the trade at 61? You will not be angry with the 78. You will say, I wish I knew I wouldn't have entered the first entry. So that's how Fibonacci retracement works. Let's read. In those two examples, we see that price find temporary FOREX support, our resistance at the Fibonacci retracement level. Because of all the people who use Fibonacci retracement level, or who use Fibonacci retracement 2, those levels become what? Self-fulfilling prophecy or self-fulfilling support and resistance level. Because if you have so many people buying from a certain level, that level becomes what? A support level. If you have so many people selling from a certain level, it becomes a resistance level.
Yes.
If enough market participants believe that a retracement will occur near a Fibonacci retracement level and are waiting to open order when the price reaches that level, then all those pending order could what? Impact the market price. Because everybody is waiting for 78. If everybody is waiting for 78, boom, market will buy. One thing you should take note of is that price will not always bounce from those levels. They should be looked as what? Areas of interest. Are you saying that?
Yes. Yes, sir.
So it's not a bulletproof. For now, there's something you should always remember about using Fibonacci 2, and that they are not always simple to use. If they were that simple, traders would always place their orders on Fibonacci retracement level, and the market will just continue going up forever. Now, right now, if you look at this is US oil. the WTI, which is US oil trade, US oil. Now the price is dropping down after forming a channel. Are you seeing the channel? An ascending channel.
Yes, sir.
So when it breaks out from the channel, the price is falling down. Now I'm going to use a Fibonacci retracement, but before I do that, I want to use Fibonacci retracement in this level, at these levels while we're going up. So that means I have to drop down to like 30 minutes so that I can see that very well. Good. 30 minutes time frame. Now let's use Fibonacci retracement right here. Let's start from the very low. Let's assume you are playing with Fibonacci. You have been using Fibonacci retracement all throughout the day. From here, let's start from this high. From here, from this high, right there, or let's start from this mid high right here. You will see, just watch. Watch what I'm doing now. From this high all the way down to this low, right? Look at what I did. From this swing high right here, all the way down to this low. Before the market did what? Reverse, right? Back up here.
Up, yeah.
Where did the market reverse from? 61.8, right? 61%. You can see that, right?
Yes.
And then it sold all the way down.
Yes.
And drop all the way down. Good. Now, move your Fibonacci. That one has given you some money. You have made money. Start from this high. From this recent high now to the recent low right there. Extend your levels. Where did the market reverse from?
61 again.
61 again. Thank you. You made another money. Come again. Put it right there. From that swing high now to this low before the market reverse. Where did the market reverse from again?
78.
78. You've made another money. Get it again. From that swing high right now. From that swing high right now, all the way to the low, which is, where is the low? The very bottom, right? This bottom right here.
Yes.
Before the market reverse. Good. Where did the price reverse from?
It's 78 again.
Thank you. Again, get the Fibonacci retracement from this 78 right there. Now, you can't do that because the market has not changed. So you can't use Fibonacci once the market is, this market did not go lower than this low. So which means we are not trending down anymore. Before we have market creating lower low, right? But this low did not go below this low, which means buyers have now taken charge. For that to happen, we can't use Fibonacci from here anymore, which means we will now use Fibonacci from where? From this low.
The bottom, yes.
Are you getting this? So our Fibonacci will no longer be from the top, will now be from where? The bottom, because this price did not go below this low. If this price had gone below this low like this, that means we'd have used Fibonacci from where? From here all the way down to this low.
Yes.
And then wait for the retracement. But that did not happen. So move your Fibonacci, turn it to the bottom side now. Now we are not going bullish. So get your Fibonacci from this low right now to that high right there. Where did the price reverse from?
61.
61. Good. Again, get the Fibonacci again from this recent low right there to the entire high on the screen, which is the one you see right there. Where did the price reverse from right now?
50.
Where did the price reverse from?
78.
78%. Good. The price almost got to 100%. Imagine you enter at 78.
Yes.
You put your stop loss under 78. You put your stop loss under 78.
Yeah, that's my mistake.
If you enter for 78, you can't put your stop loss under 78. You for that shop stop loss, Abi. But if you put it under 100%, under 100%, would you have? Okay, for still day. Okay. Now, what happened? The markets used from this low again, from that low to the recent high. Where's the recent high? That high right here. The recent high is this one. This high before the market pull back down. Where did this price reverse from?
Yes.
From 50%, right? So you don't trust 50%.
Yes.
You don't trust 50%, so you don't want to buy from 50%. And obviously, you can see the market did not even buy very much from 50%. So many people will not buy from 50%.
Right.
Then what happened? The market moved again and started dropping down. Now, when it drops down to this low right there, the same 50% is stop at. Okay, so you're not going to play all this music with them. And then the market buys up. Now, you don't enter that trade. You want to use Fibonacci again. This time, move your Fibonacci now from this 50% that you moved from, that low, right? This low right here, to the high on the screen right there, to this high right there, which is this one. This one right here. Where did the market reverse from? 78, right? It tapped in 78, yes. It move up, it come down, it play around 61, 78, 50. If you had your stop loss under 100%, would the market have stopped you out? I don't think so. No, right?
No.
And then boom, all the way up. You made all this money all the way up to the upside. So that's you using Fibonacci retracement. Now, if you look at the entire screen now, let's go back to 1 hour time frame. Because this one is consolidation right there. Serious one. We can't do this Fibonacci there. It's terrible using it there.
Yeah,
Although it was still trending, it was still an uptrend. You would have still gotten some money there in 5 minutes or 15 minutes, but in 1 hour, no. Now, this 1 hour time frame, where are we going to use our Fibonacci from? From this low, right?
Yes. The most recent.
The most recent, which is this low right here. Okay, good. Take it all the way up to the highest point, right? Right there. Now look at the market has broken out from where? From the trend channel, right? From the channel.
Yes.
And it's dropping down. It's stopped at 38%. Do you think that it's going to revert on 38? It's getting a rejection on 38 right now. But we have 50% that it's not there yet. We have 61% and it's not there yet. We have 78%, which is the Oga of them all, and it's not there yet. Do you think the price may reverse on 38%? Do you think this 38% we have enough buyers from here?
No, it won't.
It won't. Thank you very much. So most likely, what you are seeing right now is just a knee jerk. It's just testing 38.
Yeah.
Some people are still entering the sell now because it has broken this trend line. They are not selling because of Fibonacci. They are selling because of this channel. That's why they are selling.
Yeah, okay.
But why they are selling? Because the market has broken this channel. They are not drawing their Fibonacci now to not know where their take profit to be. So if you are selling from here, for example, since the market has broken out and you are selling from there, your take profit to be where? 78. That's 214 pips.
Okay.
That's 214 pips take profit right there. So that is why even the Fibonacci retracement can be used for take profit. Not just for entry. Because once the price drops all the way down to 78 again, it becomes a bargain again. It becomes a bargain again. If we go to gold, which I'm going to look at now. Wow. This market moved this way. Huh. I just look at it right now. I'm making a lot of money. Oh, wow. I'm making a lot of money. Like, wow. Like crazy. I did not even check. I've not checked it ever since. I started teaching you. I've not checked it ever since.
Yeah.
That's a lot of money I'm seeing right here. I've not checked it. I've been on the buy, but I did not check. I just started teaching because what's going to be will be. Sera. So that's the reason why I didn't bother to even look at the market. Now, it's still going up, so I'm not going to close. Seems like I'm going to have a lot of money. So let me just leave it there. Now, if you go to... No, don't jealous me yet. You're going to get there. Don't worry.
You are risking it.
No, I'm not. How can I be risking it all? I'm not risking it all. No, don't worry. Let's look at... let me show you Fibonacci retracement now. Now, this market did something. In the 4-hour time frame yesterday, we saw a bullish candle close right there. Now, I got a Fibonacci retracement starting from where? From this low right here, right? All the way to that high right here. Where did the price reverse from? Look at that. Is that not 78?
Yes, sir.
That was one of the reasons I took the buys earlier. Although I closed some profit this morning, I took it in the 9th. I closed some profit this morning and I re-enter again, which I'm holding on to a trade right now. Okay. Now, if you go to 1-hour time frame, or better still, 15 minutes time frame, there was still another level, another entry point for people to enter the trade from. The price is buying up here, and then it pull up. In the 15 minutes time frame, it did this movement all the way up here, and it came back down again. Now, I understand that some persons use the Fibonacci from this high all the way down to that low right there. And this was what? 78%. And they started selling. These people sold for me to be able to buy. God bless them. They sold for me to be able to buy. God bless them very much. Now, why I say that is that they sold. I hope they did not sell thinking that it's going to break the big 78% in the 4 hours. Now, you getting me? Please listen carefully. There is a Fibonacci 78% in the 4 hours time frame, which the market reversed from and then pull up. So which means that 78% is a support level. So there's a big support in the 4 hours time frame. And then there were some people who sold even inside within a support range, which is not nice. So when this market dropped all the way down here, I saw it here. I was like, no way, I'm not going to buy from there. No way, I'm not going to buy from there. Because that's a Fibonacci retracement level. In the 4 hours time frame, that's a 4 hours Fibonacci. That's a 4 hours 78%. I drew a Fibonacci now in the 15 minutes from this shadow all the way up here. Please, where did the price reverse from? 61.8.
Yes.
When I entered the buy from even before I even get to 61, I entered the buy already. I put my stop loss under the 100%. I say what will be. I'm going to enter this trade because I already saw the candlestick pattern, the bullish engulfing candlestick pattern on the 4 hours time frame. So the bullish engulfing candlestick is already a pattern telling me that the market is going to buy. A bullish engulfing from a what do they call it? Fibonacci retracement level.
Yes, sir.
Now, take note. This particular forex.com in the 4 hours time frame did not have a bullish engulfing candle. If you look at that very well, that's not a bullish engulfing candle. Right? Look at those two candles together. That's not a bullish engulfing. But I'm going to walk you through this and take you to gold. One moment. Let me take you to gold. I would have shown you gold trade in my EXNESS. I use EXNESS broker. Now, the EXNESS broker, that was going to waste me time if I want to show you that now. Now, the EXNESS broker in 4 hours time frame, I saw the bullish engulfing. And when I correlate it with this one right here, and I saw the candlestick, I said, well, that's also a bullish pressure because it has a shadow at the bottom, which is a rejection before the market pull up. I said, I'm going to take that buy. So when this price returned back down partway through, that's when I entered the buy. So using Fibonacci retracement is very important when you trade. Look at this. If they were that simple, traders would have placed their trade on every Fibonacci retracement level and the market would trade forever. So it's not easy to use, but you definitely get used to it as time goes by. One way to get it clearly is identifying the swing highs and lows to use. Before now, when I took that buy on Fibonacci retracement level, when I took that buy, I expected the market to sell back from here, somewhere around here. So when I bought from here, I expect the market to what? Sell from here. The market goes all the way up and gave me this tiny candle. You see this candle? It gave me this candle rejection. And I was like, let me close my trade. So I closed some trade and I left one at the bottom. Again, I closed another one. And then when I closed the last one, I was like, let me buy from here again and use a tight stop loss, because I saw what the market was doing there. So I entered the buy from that level right there. And then I was expecting the market to return from here, but this is a treacherous movement. But I do feel that there is a news. I think there is a news that is doing this movement. It's not an ordinary movement. Definitely not ordinary because that candlestick is too long to be a technical analysis candle. Technical candle. U.S. Treasury announced.
It did not even break.
It did not even break. Okay, that's the news right there. U.S. Treasury announces increased size of nominal long end. Okay, so that's the news that came out 26 minutes ago. And that's the reason why the market is moving up. So that's the news right there. On terms of the calendar, there is no news in the Forex in the calendar to look at that played out. But there was a normal news that came out from the US. So this is the news that came out 26 minutes ago. And that was the reason why the market starts moving.